Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Phil Mackintosh, chief economist at Nasdaq, to discuss the impact of the sharp rise in commodities on inflation and corporate earnings. Phil, it's great to see you as always. Welcome back to Trade Talks. And let's kick this off with a quick market review. And what we've seen are just some pretty incredible volatile sessions and the velocity of the moves within every index, within every commodity.
Yeah, not necessarily surprising though, really, given what's going on in the world. Obviously, huge outcomes, just different outcomes are possible in terms of what happens with companies and earnings, what happens with rates and bond security, and obviously commodities. We know that Ukraine and Russia are massive producers of different commodities. And so the likelihood that supply is affected is going to affect prices, make things more expensive for a little while to come, at least.
Right. And let's take a look at that. Many commodities have gotten more expensive. It isn't just oil and gas that we're taking a look at, not even just the ags itself. It seems like it's hit just about every sector in the commodity space.
Yes, I mean, Ukraine produces a lot of agriculture, so wheat and a lot of the grains are actually starting to be priced in as if there's going to be a shortage of supply coming out of there in the summer. A lot of metals come out of both countries. Some of the metals are important for some of the I guess, green energy that we want to replace the oil and gas with. And obviously, Russia is 11% of the world's oil supply. It's around about 40% of Europe's gas supply. So it's a huge supplier of those commodities too. And all of the complex of those commodities has gone up: agriculture, metals, and energy.
And Phil, does that mean inflation lasts longer? And do we start talking about recession here? We know that this is putting pressure on people's ability to spend. And if we're not seeing any spending, we know what's going to happen with the economy.
Yeah, so I mean, rewinding a little bit, we've been talking about the fact that inflation here is really quite high, but it's kind of meant to be a bit short term, where we start to see energy, starting to come back out of the inflation story. We see a lot of the COVID going away from the market, and you get a little bit of, I guess, a return of workers, which takes away a lot of the pressure on wages. What we're probably going to see now, if you look at some of the forecasts, is the doubling in the price of oil could add as much as 2 percentage points to the CPI. And so for at least the next 12 months, it's going to be harder to get inflation to come down. That just makes life a lot harder for the Fed, because we've been talking about the Fed maybe being able to ride a bit of a wave of the fact that all of the supply and demand pressures would also bring inflation down. But if now we've got energy inflation coming back into the picture, we've got interest rates needing to go up to tackle inflation, but at the same point, a lot of spending is going to get soaked up by all of these more expensive commodities. And we might actually see people spending a little bit less aggressively with a war in the background too. So even harder to navigate a soft landing for the Fed. It's definitely going to change things up.
Right. And if we could pull up that chart that we just had up there, got a little bit ahead of ourselves here. Let's see how it could potentially impact earnings, because Phil, we're starting to see that analysts are being told by the companies, you know what, your expectations might be a little bit high here. And we saw that in the chart that was just up with the bar chart there.
Exactly. So if you look at the red is what you want to focus on. That's all the companies that are saying to analysts, like, slow down. What you have in your numbers might not be as positive as we're going to be, but we're not saying earnings are going negative yet for companies, but we're just saying that last year was a really good year for companies. We know that earnings grew about 30%, and it might not continue at that rate. And I guess with all the commodity prices going up, that's going to squeeze margins. And so you've probably got a few different headwinds. To your point, if people are able to spend less because of inflation too, there could be a demand coming down as well. So less products being sold, tighter margins, not so good for companies in the short term, but still positive.
And finally, Phil, one bright spot appears to be COVID. And I understand the headlines have really been dominated by geopolitics, and we haven't really spoken about COVID as much, but the data that you've provided in these charts here shows that, it really has dialed back here.
Yeah, my personal wish is that this is the last time we do COVID charts, but it's kind of interesting. So if you think about how science has tackled the COVID problem over the past 2 years, you can see the red line on the left-hand chart there. The probability of COVID making you really sick or maybe being fatal has come down pretty significantly, especially the first arrow there you see as vaccinations rolled out. And then Omicron, we know, hasn't been nearly as fatal as some of the earlier versions. So basically where we're at now, the average COVID case is about as deadly as the average flu case used to be, which is great news because we didn't used to worry about the flu. And the really good news for anyone that's vaccinated, and especially if you're vaxxed and boosted, is the chart on the right shows basically the people that are vaccinated have a much lower than average chance of getting really sick and maybe having a fatality because of COVID. So the news on COVID is science has sort of fixed a lot of the problems and brought the risks way down.
Yep. How about that? Science work, doesn't it, Phil? All right. Thanks for joining us on Trade Talks as always. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.